Project Vault is buying gold and silver claim is not publicly confirmed, so I'm rebuilding that section around what is confirmed and what it could realistically mean for metals. Hello everyone, and in just a few months, the Trump administration has gone from warning about America's dependence on foreign minerals to launching a massive critical mineral stockpile. While long-term Treasury yields stay elevated, silver remains violently unstable, and investors are trying to figure out whether gold and silver are about to be pulled into a much bigger policy-driven trade. But here's the part people need to be very careful with. There is still no public confirmation that this stockpile is buying gold or silver directly. So in this video, I want to make sense of what is happening by walking you through Project Vault, why it matters even without a confirmed gold or silver purchase, what rising Treasury yields are telling us, and why the silver market is still flashing a very unusual mix of strength, stress, and uncertainty. And today is Sunday, May 17th, New York time. Comment what day and date you're watching from. Are we watching a policy shift that could end up affecting gold and silver far more than most people expect? And if you value my work, support the channel by subscribing and commenting John AG. So, jumping in, the first thing we need to separate is what has actually been announced from what people are assuming. Project Vault is real. It is a large U.S. critical minerals procurement initiative backed by public financing and private capital, designed to reduce shortage risks in materials that matter for defense, technology, energy, and industry. That matters. But the leap from critical minerals stockpile to Washington is already scooping up gold and silver has not been publicly proven. And when a market is already emotional, that distinction is not a small detail. It is the difference between a confirmed policy development and a story that may be running ahead of the evidence. Now, that does not mean Project Vault is irrelevant to gold and silver. What it tells us is that resource security has moved from the margins of economic policy straight into the center of it. For years, investors were told to think mostly about earnings, rates, and consumer demand. But governments are increasingly thinking about inventories, supply chains, shipping lanes, export controls, and whether vital inputs can actually be obtained when they are needed. That is a different backdrop. And once governments openly treat raw materials as strategic assets, investors naturally start paying closer attention to metals that have historically functioned as both industrial inputs and monetary insurance. That is where gold and silver enter the conversation, even if they are not yet named inside the stockpile itself. And this is where the story gets more interesting, because the metals market has not behaved like a calm, ordinary market this year. Gold has stayed elevated even while rates remain high. Silver has swung from explosive enthusiasm to brutal reversals and back again. Based on recently published numbers, the silver market has experienced one of the sharpest boom and bust episodes seen in years, with leverage, margin changes, and forced repositioning all magnifying the move. And that matters because violent volatility often confuses people. They see price falling and assume the whole thesis is dead. They see price rising and assume scarcity has already won. The truth is more complicated. Price can tell you what is happening in the moment, but not always what is being built underneath the surface. That is why attention has shifted toward physical market behavior. In calmer years, many investors barely cared about delivery mechanics, warehouse movements, or whether buyers wanted metal exposure versus actual metal. Now those questions are being discussed constantly. From recent market updates, the conversation around physical tightness in silver has become much louder, especially when prices weaken, but demand for real-world metal does not simply disappear. I would be careful about making claims that every unusual warehouse movement proves a hidden government buyer. That is not something we can state as fact. But I would also be careful about dismissing the entire issue. When more participants start caring about possession, deliverability, and supply certainty, that tells us confidence in easy liquidity is not as strong as it used to be. And that brings us to the single macro indicator I think deserves the most attention here, the long-term Treasury yield. Not because one chart explains everything, but because it sits right at the intersection of debt, confidence, asset valuations, and financial pressure. The 10-year Treasury yield has remained elevated, and that matters because higher long-term borrowing costs ripple through mortgage markets, business financing, government interest expense, and the discount rates used to value stocks. People sometimes talk about yields as if they are just a bond market issue. They are not. They are a pressure gauge for the whole financial system. If long rates stay stubbornly high while debt remains enormous, eventually somebody feels that strain. One point from the broader market debate needs to be challenged directly. The new stablecoin framework may increase demand for very short-term Treasury assets, because properly regulated payment tokens need reliable reserves. That is a fair point, but it is not accurate to say all money will suddenly move through stablecoins or that this somehow neutralizes the Federal Reserve's influence over short-term rates. That goes much too far. The law creates a regulatory structure for payment stablecoins. It does not turn every dollar transfer into a blockchain transaction by command. and it certainly does not eliminate monetary policy. So yes, stablecoin growth can matter at the front end of the Treasury market, but the long end of the curve still reflects broader judgment about inflation, fiscal credibility, and the amount of risk investors want to carry over time. Which is exactly why the 10-year yield remains so important for precious metals. Gold does not need every bond investor to panic. It only needs enough people to doubt that paper assets will compensate them fairly after inflation, deficits, and policy uncertainty are considered. When real returns feel questionable, gold becomes harder to ignore. Silver then gets pulled into that conversation from two directions at once: as a precious metal that benefits from monetary anxiety, and as an industrial metal tied to electronics, vehicles, power systems, and advanced manufacturing. That double identity is what makes silver powerful, but also what makes it more unstable. It can move like a safe haven one week and like a high beta commodity the next, and we have already seen just how unstable that can be. Earlier this year, silver experienced a spectacular run, then a harsh drop, and the market spent weeks arguing over what really happened. According to the latest publicly available analysis, leverage played a real role. When prices move too fast, leveraged products rebalance. Futures traders face higher collateral requirements, and forced selling can feed on itself. That does not automatically prove an intentional takedown. Sometimes a violent sell-off is simply what happens when too much speculative positioning is stacked on top of a thin market. But it also does not mean the underlying physical story vanished overnight. A sharp technical break can punish traders while leaving a broader supply issue unresolved. Both things can be true at the same time. That distinction matters because silver's deeper fundamentals still look unusually tight. Major industry forecasts continue to point toward another annual deficit in the silver market. Mine supply may rise a little, but not enough to erase the gap by itself. Physical investment demand has been expected to strengthen, while some industrial categories remain resilient even as others cool. And one of the most important details is that most silver is not produced by companies whose only goal is to mine silver. A large share comes as a byproduct of copper, lead, zinc, and gold operations. So when people say higher silver prices will solve the supply problem, that is only partly true. Higher prices help, but they do not instantly rewrite how the mining industry is structured. That byproduct issue is huge. If copper projects slow, if permitting drags on, if financing becomes more expensive, or if processing bottlenecks become more serious, silver supply can remain constrained even if the silver price itself looks attractive. Investors often imagine a simple supply response. Price rises, miners dig more, shortage disappears. Real life is messier. Mines take years. Refining capacity matters. Environmental approvals matter. Capital costs matter. Labor matters. And if silver arrives indirectly through the economics of other metals, then silver supply may respond slower than people expect. That is one reason this market can stay tight longer than the casual observer thinks. China also matters here, but it needs to be discussed carefully. Recent trade data showed a striking surge in Chinese silver imports, and export licensing has become a bigger part of the conversation. That is meaningful. It points to a country taking tighter control over strategic materials flows, while domestic demand remains strong. But it would be sloppy to say China simply stopped exporting silver altogether. That is not the confirmed picture. The more accurate framing is that silver trade is becoming more managed, more strategic, and more sensitive to policy choices. And in a market that already lacks a giant cushion, even administrative changes can alter expectations quickly. India may be even more important in the near term. Just in the past few days, India moved to tighten silver import rules after already raising duties on gold and silver. That development cuts both ways. On one hand, it can pressure import volumes and temporarily cool demand. On the other hand, when a country that depends heavily on imported silver starts restricting flows, local tightness and premiums can become a bigger issue. So the bullish silver crowd should not treat every policy headline as automatically positive, and the bearish crowd should not assume restrictions mean demand has vanished. Policy can suppress one channel of buying while intensifying stress somewhere else. That is the kind of nuance this market now requires. And this is really the thread tying the entire story together. Project Vault shows governments are thinking strategically about materials. India shows precious metal demand is now large enough to create trade policy responses. China shows metals trade is increasingly filtered through national priorities. The silver deficit shows physical balance remains fragile. The bond market shows investors are still demanding a meaningful return to hold long-term government debt. Put those pieces together, and the title of this video starts to make sense. Not because Trump has publicly announced some secret order to buy silver bars by the truckload, but because his broader resource security agenda is unfolding at the same time gold and silver are already sitting in a highly sensitive macro environment. That combination can move prices more than people realize. Now, I also want to address something that gets lost whenever a dramatic metals story goes viral. Gold and silver do not move for only one reason. They respond to inflation expectations, dollar strength, real yields, geopolitical stress, central bank behavior, industrial demand, retail speculation, and plain old positioning. So when someone says one single policy move will send silver straight up forever, that is too neat. Markets are rarely that neat. The more realistic view is that policy can tilt the field. It can change the probability distribution. It can make a shortage matter more. It can make investors take hard assets more seriously. But it does not eliminate drawdowns, and it does not guarantee a straight line chart. That is exactly why the wild volatility this year should be taken seriously rather than romanticized. The strongest case for gold right now is not that Washington has confirmed a direct buying campaign. It is that the world is becoming more comfortable with the idea that financial and resource security matter more than convenience. Gold thrives when trust is being repriced. Trust in currencies, trust in debt markets, trust in political stability, trust in supply chains. Silver thrives when that same distrust collides with real-world consumption and limited physical flexibility. If you want the cleaner monetary asset, gold has the simpler story. If you want the more explosive but messier asset, silver has the stronger torque. That does not mean silver wins every week. It means the setup has more moving parts and potentially more force when those parts line up. And if you're successful, share your success story in the comments so others can stay motivated. Because this market has already tested people emotionally. It has rewarded patience, punished chasing, and exposed how dangerous it can be to confuse a violent price move with a complete change in reality. The investors who usually do best are not the ones who scream the loudest every day. They are the ones who understand what they own, why they own it, and what would actually disprove their thesis. If the deficit closes, if investment demand fades, if trade restrictions loosen, or if yields fall cleanly while the dollar strengthens, then the metals story can cool. That possibility belongs in the discussion too. But as of right now, the pressure points have not disappeared. Long-term rates are still a concern. Resource policy is still becoming more aggressive. Silver supply is still not obviously loose. China and India are still shaping the global demand picture. And Washington is still telling industry, through action rather than theory, that strategic materials matter. That is why I think gold and silver investors should pay attention to the Trump administration's mineral strategy. Not because every rumor should be believed, but because the confirmed policy direction lines up with a broader world that is becoming more protective, more fragmented, and more resource conscious. Those are conditions in which hard assets can stay relevant for longer than many expect. So where do you think the bigger pressure point is now? Washington's mineral policy, elevated long-term yields, or the silver supply squeeze? Let me know in the comments below. And if this breakdown helped you separate the confirmed story from the hype, leave a like, subscribe, and share it with someone who follows gold, silver, or macro markets closely. I'm wishing you a steady week ahead. Take care of yourselves, take care of each other, and remember that this discussion is meant to help you think through the landscape, not to hand you a personal trading instruction. Nothing here is financial advice. It is educational commentary built to help you ask sharper questions before risking your own money.